Thanks and welcome everyone to Lipper's first quarter 2014 fixed income review. I'm Jeff Tjornehoj. Well, as Tom pointed out, there was a lot of interesting economic news and political news that evolved over the quarter. This is a wide view of fixed income performance over the quarter. At the very bottom in blue, high yield muni was the quarter's best performing classification. We saw like short treasury funds, that little tiny red square near the top, turn in some of the relatively worst performance, but all around positive numbers throughout the industry when it came to fixed income performance. And we're going to walk through several of these. Not going to hit every single one, but you're going to see why everything looked pretty rosy for bond fund investors. So the first group we're going to take a look at is general U.S. Treasury funds and inflation-protected bond funds. As Tom mentioned, unusually cold weather was widely blamed for the lax economic data in January and February and later in the quarter. We heard that Q4 real GDP growth was revised higher, so that would tend to bode poorly for bonds. Because that GDP growth went from 2.4 to 2.6%. We saw equities get lifted in January on that. He pointed out that some of the monthly jobs data was coming in higher. It was below expectations, though, and that weighed on equities. So a mixed picture, if you will, and that was good for treasuries. So we saw a bounce back in intermediate to long duration treasuries. For example, the iShares 20-year plus treasury bond ETF, which is ticker TLT. It's a long duration treasury product. It had a Q1 return of 6.4%, which was fantastic. That's a very good start if it's going to erase last year's nearly 14% loss. So there's suddenly this year a big jump into treasuries, a lot of interest, probably buying on the dip, so maybe some technical reasons for it. But we also saw, as Tom pointed out earlier, there's some economic concerns as well that would lead people to safe haven plays. Lipper's inflation-protected bonds fund group gained 1.6% on the quarter. There's still a note of caution with that performance, though. It also produced the worst return in the fixed income universe in March, which was about negative 40 basis points. Treasuries were starting to sell off near the end of the quarter. Inflation concerns were eased when the February data came out and said it was just at 1.1% on an annual rate in February. So that took some of the appeal away from inflation-protected securities. I think towards the end of last year, I think the mood out there was that 2014 was going to see continued improvement in the economic data, and that would likely start to bring inflation back in some parts of the economy. As Tom pointed out, you could see it in various corners of the commodities market. We're still not seeing it in wage prices, though, so that probably took a little bit of the froth out of the inflation-protected securities market. You know what's As an aside here, government bonds held at the Federal Reserve for foreign central banks dropped by about $105 billion near the end of March, which was a weekly record for that data. Although it's not confirmed, it's widely assumed that this was done by Russia, maybe as a sign that they were not going to tolerate Western influence in their annexation of Crimea, and they don't like what we're saying about their influence in the Ukraine as well. But I wasn't terribly concerned by that because Japan and China are still two huge owners of treasury products out there. Record levels of treasury ownership by China and Japan's central banks at the end of the year. So Russia's move, $105 billion probably rattled the market a little bit when it came out, but it's still relatively small in the scheme of things. The other points that were still good for bonds in general and treasuries specifically, weaker consumer sentiment numbers came out on Q1. We saw China's economy, although the manufacturing index is still above 50, it dropped from 50.3 to 50.2 that, again, probably contributed to some support in the Treasury market as China's economy is still very tightly balancing between recession and expansion. And certainly the mess in between Ukraine and Russia is going to keep Treasury prices firm. So let's take a look at the Treasury yield curve over a number of periods. From you can see the solid red line here is where we ended the quarter. The light orange line above that is where we began the quarter. So as you can tell, the yield curve flattened a bit. Despite the flurry of activity in March, again, going back to China, about Russia, and as Tom mentioned earlier, Janet Yellen's 6-month utterance, which spooked some Fed watchers because it seemed to indicate that they would start to raise interest rates sooner than expected. I think she probably gave enough qualifiers around that I think the market was reading her lips too closely. I think she was saying at the earliest it was 6 months, but it could be 9, could be 12. I mean, she was trying to get away from being specific. I think she kind of fumbled the message a bit in her first real press conference with the press. So essentially, all the declines in yield that we saw in the first quarter happened in January. The 10-year note started the year at about 300 basis points. It was fairly steady till about January 10th. Then it dropped about 9 basis points. Then it gradually worked its way lower. It ended the month at 267, which is pretty good. It really didn't sell off any higher than about 2.8% in February. It finished at 266 basis points at the end of February. And finally in March, a little bit of give back. It ended at 273 basis points. So overall, that 27 basis point drop in the 10-year note was the largest quarterly rally since Q2 2012. I'm talking specifically about the 10-year Treasury. And that's also what helped the general U.S. Treasury Funds Group post a quarterly return of about 3.6%. So a very good rally in Treasuries. Most of it came relatively early in the rest of the quarter. We were starting to give it back a little bit, drips and drabs here and there. Next group to take a look at is a lot of our corporate groups, Core Plus Bond, I should say, Triple B, High Yield, Loans. These are all interesting plays right now. The A-rated funds group, which is not highlighted here, but it's immediately under the Triple B. That was up about 2.9% in Q1, and Triple B funds climbed 3%. So just a slight distinction between the two of them in terms of performance, with Triple B outperforming A, both outperforming High Yield. Kind of a strange dynamic there. The Core Plus group above them, the first one that's highlighted, was up about 2.2%. This was that classification's best quarterly return since Q3 of 2012. Now, along this in this quarter, the option-adjusted spreads on corporate Triple Bs dropped from 174 to 160 basis points, and that's their tightest spread to Treasuries since July of 2007. I will add that between 2004 and 2006, they traded between 110 and 170 basis points. So there's still precedence for going tighter to Treasuries. We'll cover that again in my outlook. High yield spreads also dropped to 2007 levels. The OAS on the High Yield Master 2 Index, which started the year at 400 basis points, settled in at 377 at quarter end. So corporates were looking pretty strong throughout the quarter, and this next slide gives you some indication of why that was. We saw high yield issuance. It's the blue columns here. They came in at about $55.5 billion in Q1, which is 9% lower than Q1 of 2013. This is the slowest start for high yield in 2 years in terms of issuance out there. Mutual funds and ETFs in our high yield classification had about $3.9 billion in net inflows, which is about twice what they did in Q1. Investment grade issuance, which is the brown columns here, reached 331, almost 332. 311, almost $312 billion in Q1. That's a 12% increase over the same period a year ago. This has been the best Q1 on record for investment grade issuance. And according to our friends at Thomson Reuters LPC, which is the loan group over there, Q1 saw about $276 billion of leverage loan issuance. That's the third highest quarterly total going back to 1987. A lot of observers are starting to worry over the increasing reliance of covenant-light loans, as well as a lot of second lien loans to fill demand. That suggests that the borrowers are really in the driver's seat right now. The loan funds classification had a return of 94 basis points in Q1. That's pretty much on target. As I said in my write-up, its 10-year annualized return is just under 4%, so they got about 1% in this quarter. It looks to be about on target. We're also going to look at the yield curve for corporate debt. This is the total return indices right here. And the blue area is where is first quarter performance, and this is again on the indexes here. As we pointed out earlier, option adjusted spreads on corporate debt were pretty tight. They did, as Treasuries rallied, so did corporate debt. As I mentioned before, BBB outperformed A, which outperformed high yield. High yield right now is on a little better path. It's been in play since the middle of 2013, and it's had a fairly smooth, strong performance. So when it's relatively underperforming, it suggests to me that perhaps either those other areas like BBB and A were oversold earlier, or that BBB is starting to get into pricey territory. Its spreads over Treasuries are still pretty good. As I said before, they're about 377 basis points. It'll be tough for that to narrow much further, which is why I expect high yield to also play second fiddle to BBB over the coming quarter as well. Next group to take a look at is in our world income. We'll take a look at hard currency and local currency funds. The hard currency had a quarterly return of 2.44%. That was the best overseas group. Conversely, local currency was the worst performer. It was only up about 1.14%. So when we look at how these two have compared over the last couple of years, going back to the end of 2012, they tended to run together pretty tightly, and then last year at the end of the third quarter or so, we saw the difference really start to become evident as hard currency. Let me get my wording here correct. Hard currency funds were outperforming the local currency variety. Since that time when they last were running together, hard currency was up about 1.4%. Local currency down 6.2%. So corporate debt from emerging market issuers was pretty low this quarter. It was about $68.2 billion. That was 29% less than where Q1 2013 stood. As I mentioned in my write-up, this might be a sign of future problems for Vladimir Putin and his oligarch friends. The corporate Russian debt issuance was just $6 billion in Q1, and that's down 70% from a year ago. So Russian companies are having a hard time bringing new issues to market. And then finally, let's talk about munis for a little while. They had a spectacular quarter. It took a couple of weeks, but retail investors rediscovered munis in 2014. They had net inflows of about $2 billion, which, although it's still rather small, was an important way of keeping the bid in the market for munis. They opened up with 9 straight weeks of inflows using our Wednesday to Wednesday calendar. Certainly Detroit and Puerto Rico have not been forgotten, although I would say that that's starting to fall behind in as far as investor memories are concerned. They're probably looking ahead to other potential problems. Puerto Rico still has some issues out there. I think we'll see more of this evolve probably in the third and fourth quarters of this year. Chicago is really what's on the radar as the next big problem to solve, although it's not going to be solved anytime soon. High yield muni debt funds had a return of 5.25. That was the quarter's top overall group. A lot of the single state long-term classifications were between 330 and 390 basis points. A stellar quarter for them. It'll be a tough act to follow, but it's a great start to the year. So let's take a look at how General and Insured, our largest national muni group, fared. This was their best quarter since the second quarter of 2011. Longer duration portfolios definitely held up better and avoided the losses in March. There were some scattered losses, but largely everyone fared pretty well. Investors were scrambling toward the long end of the yield curve. That's where the performance was. And let's turn our attention back to Puerto Rico. Again, here's the yield curves for Puerto Rico at the end of this quarter versus the end of 2013. This quarter, we saw their rating downgraded to BB plus from BBB minus at the end of the year. Yields dropped, which was a good sign. That's a rally for Puerto Rican debt. They had an issuance this quarter they went to market with. You can compare that to the lines below, which is AAA paper from other general obligations throughout the country. That yield curve also dropped, but not as dramatically. It's just getting a little flatter mostly. So when we saw the Puerto Rican debt rally, it really rallied from the belly of the curve. It sports a bit of a frown now, which makes for good speculation. Doesn't mean the island is headed for a recession. Does it mean we're on the eve of something worse, or does it really just mean nothing, and this is just a data artifact, and it just tells the market what it thinks of itself? And these are all good questions. It's hard to know right now what it all means. It may just reflect the technicals associated with its recent bond deal. So anyway, it's a good indication of where and why municipal debt rallied so well. Certainly those portfolios that held a lot of Puerto Rican debt did exceptionally well given what happened with Puerto Rican paper this quarter. So here's my outlook. I still believe that Treasuries will stay fairly range-bound. As Tom pointed out, cold weather is blamed for poor economic results in January and February. However, I saw commerce data on the inventory to sales ratio, which has been showing a buildup over the last several months, and this precedes the cold weather pattern. So this bodes well for bonds as far as data to look at for forward-looking views on the economy when that inventory to sales ratio is expanding. It suggests to me that businesses are building up inventories and sales are not meeting expectations. I think corporate spreads have more room to tighten. Corporate defaults are still very low. I do qualify that a little bit. I think high yield is going to lag some of the higher grade areas for a little while. When it comes to loans, I think the returns are going to slow down. We got 96 basis points this quarter. I think over the next quarter or two, that would be a nice pace to settle on. Lots of covenant-light loans, a lot of at-par issuance that suggests that it's getting a bit overvalued. Emerging market hard currency, I think, will continue to beat the local variety. Brazil and Russia are going to weigh on those local currency prices. Russia especially, I think, is going to keep dragging it down. And when it comes to munis, I think they're going to do relatively well in the quarter ahead. Still priced well, more room to run. The ratio of AAA general obligation muni debt to 10-year treasuries was at 94% at the end of the quarter. The 12-month average right now is about 103%. Once it's over 100, that's definitely a buy signal for a lot of muni investors. I think we're going to get to 100 during the quarter, and I think we're going to see a further rally in munis from that. So I'd like to conclude my presentation, and if we have any questions, which we don't, I will turn it over to Barry.